All right, this is problem set 2, question set 2, question C, I guess. The standard deviation of returns to the portfolio comprising 60% Apple and 40% Ford is more than the standard deviation returns of Ford alone, but this portfolio is diversified. How can it be the case that a diversified portfolio is riskier than investing in a single stock? Okay, so let me just show you the portfolio first. Here are the standard deviations of the individual stocks, and here is the standard deviation of uh, the entire portfolio. And you notice that it's pretty close to, well, it's not pretty close, but it's in between the two. And so essentially what we're getting here is benefits to diversification, but without with kind of a free lunch. So for instance, let's say that we didn't take all of this into account, that we just did a weighted average. And so what this gives us is the covariance. It sort of adjusts for the covariance and helps us take that into account. But let's say that we just wanted a weighted average. This may not be super. So if all that we did was just count the variance of each of these, so 60% of the variance of Apple, which is 60% of our portfolio, and 40% of the variance of Ford, which is 40% of our portfolio, we get a variance of 24%. So this is just a straight average. Notice that when we take into account the variance covariance, or the covariance of these two, our standard deviation for the portfolio actually decreases. And the whole point here is that we got a free lunch. So diversification did help us. In fact, if we just did the weighted average of these two, we would expect to be at 24%. But when we took the covariance into account, we were only at 21%. And the reason for that is that Apple is such a big portion of our portfolio. So if we really hated risk, we would only invest in Ford. But we can invest in Apple and increase our expected return and do it for less risk than we would expect if we were just naively saying that the risk would be 60% of Apple and 40% of Ford. So the answer here, and let me just make very clear, this is not the correct way to do it. But this was the central insight of the CAPM model, which is that it's not just a weighted average for risk, that when you take into account covariance, that this magical thing happens where the risk goes down, but the return is just the same. Again, do not do this on an exam. You will get it wrong. Do this on the exam, but know that the beauty of this model is that this number, which we naively would expect, actually goes down. And in fact, if you say that the, let's see, is it 1? Yeah, if you say the correlation is 1, then you get the same answer for here and here. But when we go back to 0.35, then we get a 21. And notice, just this is kind of interesting, when the correlation is 0, we actually get really close to the Ford standard deviation. And the reason for that is that we get all of the benefits of diversification with none of the risk. So let's go back to 0.35. Okay. So with that in mind, diversification only starts to benefit portfolios in stocks of 30 or more. That's clearly wrong. We just showed you it was not the case. Portfolio theory only works in the presence of a perfect capital market. It works best there, but diversification benefits everybody. That's why we have mutual funds. So that answer is wrong. Both Ford and Apple are likely to plot below the security market line, and this negates the benefits of diversification. I don't know if you guys remember it, but we had like this frontier, and it looked kind of like this. And Ford and Apple are probably both in here. They are underneath the line, but it doesn't negate the benefits of diversification. By diversifying, you get to go up and towards the line. So that one's wrong. Diversification only provides benefit if there is a risk-free asset available for investment. That's not correct. A risk-free asset allows us to travel along this line, but diversification will benefit you no matter what. So it's got to be E. There's a weight on the riskier asset. This outweighs the low correlation of returns. And what I'm showing you above and beyond what's in the solution is that naively, if you did this, you would be getting this percent return or this percent risk. but you're actually only getting 21% risk. So diversification benefits you no matter what. It just so happens that we heavily weighted a higher risk stock, and so therefore the portfolio risk is higher than Ford, but it's not as high as it would be if the correlation was 1.